Good afternoon and welcome to our second education series of 2022. My name is Chad Fett with First State Bank and Trust, and we're excited to provide these monthly educational events for you. And I encourage you to visit our website and look for the upcoming monthly events. Today we have Joe Mahon of the Federal Reserve Bank of Minneapolis. We'll be here discussing the Federal Reserve and its role in the economy. Joe will also touch on the ongoing impact of the pandemic, increased inflation rates, and will provide commentary on the labor market and unemployment rates. Joe Mahon is a regional outreach director for the Federal Reserve of Minneapolis. Joe's primary responsibilities involve the tracking of current business conditions across the sixth state 9th district, which includes Northwest Wisconsin, Michigan's Upper Peninsula, Minnesota, North Dakota, South Dakota, and Montana. Along with tracking the overall economy, Joe closely follows the agricultural, manufacturing, energy, and mining sectors. He pays special attention to prices that families and businesses pay for goods and services, which is central to the Federal Reserve's dual mandate promoting stable prices and maximum employment. Joe's given the wave that he doesn't need to have more, but he's a central contributor to the beige book, and we are excited to have you here, Joe. Yeah, welcome.
Yeah, thank you very much for having me. I appreciate the opportunity to present to the folks out there virtually and also in person here today. I'm going to be talking today really more about national economic conditions. So my role and my title at Fed is a regional outreach director, but my role is really more of a regional economist. But as Chad just described in his introduction, I have some sectors that I focus on. In particular, I track prices pretty closely. My colleague Ron Wirtz is going to be presenting through this venue next month, and he's going to give more of a regional picture. So I think folks are really interested in what's happening in terms of inflation right now. And that's really the big news, is this surge we're seeing in inflation that's been going on over the past year or so. And so I'm really going to talk about that and what the Fed's response is to it. And in order to do that, I need to provide a little bit of background on the Fed, our role in the economy. And so I'm going to start with that. Before I go any further, though, just to, if I could get to the next slide here, and just want to start with this standard disclaimer that my opinions are mine, not necessarily those of the Fed. I'll be explaining in a moment kind of what the Fed's role is and how we're structured. In spite of the word federal in our name, we're not actually a federal agency. We're an independent nonprofit corporation, public-private partnership that was created by the Congress of the United States. In order to do a good job with monetary policy, we try and maintain some independence from the political process. And because that's important for us to do a good job, we try and stay out of politics too. So that doesn't mean that I don't have political views or other views. I just want you to know that those are mine, and I'm not necessarily speaking for my colleagues. So here's what I'm going to be talking about today, if you could advance. Go ahead and click through the bullets here. There's a few of them here. Yeah, so I'm going to be giving some background on the Fed. I'll be talking about the national sort of picture. In particular, I'm going to focus on how we're doing relative to two goals that Congress has set for us, what we refer to as our dual mandate, and in particular, I'll be emphasizing what's been happening for the last year with employment. And I'm going to talk a little bit about how the pandemic is kind of still having some of its consequences on what we're seeing right now happening in a national picture, how that's kind of figuring into the accelerating inflation that we're seeing right now. On the next slide, I'm going to just show you a map of the Federal Reserve System here to kind of give you a little bit of an idea how we're structured and what makes us unique. So we're America's central bank. Just like pretty much every other advanced industrial economy has a central bank. Bank of Japan, Bank of England are a couple examples maybe come to mind. What makes us different from other central banks is that we're decentralized, and this is kind of owing to our long tradition in American history of distrusting concentrations of financial power. So when the Federal Reserve was designed in the early 20th century, they wanted to decentralize the authority and decision-making power within the system, so they carved the country up into 12 Federal Reserve districts. And that's what makes us federal, actually, is just like the United States has 50 states and a federal government, we're a federal system of these 12 Federal Reserve districts. And on the next slide, you can see in Minneapolis, we're responsible for, as Chad said at the outset, the states kind of in the north central United States. I appreciate that you went through them from east to west, and you started with Wisconsin. So yeah, Wisconsin, Minnesota, North and South Dakota, Montana, and the Upper Peninsula of Michigan. We split parts of Wisconsin and Michigan with our colleagues in Chicago to cover the other parts of those states. So large district geographically. We're actually the smallest in terms of population of all the districts, but we have a fairly diversified economy, particularly Minnesota and Wisconsin. If you look at the economies of those two states, they almost look like shrunk down models of the national economy. But I'm not going to spend a lot of time, like I said, talking about regional issues today. I'm going to be focused on more the national picture. And if you could actually skip ahead 2 slides, I kind of want to set up one really important sort of level set point here to kind of understand, so you can understand kind of sort of frame everything that I'm going to be presenting to you. So the Fed's responsible for a few things. We are a bank. We serve as a banker's bank. We provide the reserve part of our name is that we hold reserve accounts for depository institutions. We're also a bank regulator. We have the authority, what we were originally created to do, which is lend to financial institutions in times of short liquidity or in times of financial emergency. Because we have that authority, we also have some authority to regulate financial institutions to try and prevent those situations from happening in the first place. And we do that both at an institutional level and also kind of a systemic level, and that's kind of a broader, bigger focus since the financial crisis and Dodd-Frank. So the Fed is one of several kind of systemic financial regulators. But the thing we're best known for is monetary policy, which is one of the sort of 2 levers of national macroeconomic policy. And that is the influence of the supply of money and credit in the economy. In the financial press, on the news, it's often referred to as moving interest rates, the Fed raising or lowering interest rates. Right now, we're raising interest rates to get inflation under control. But really, what that is ultimately in the service of is what we call our dual mandate. So by act of Congress, we are required to make monetary policy with 2 goals in mind. And those are maximum employment and price stability. We want to make sure that everybody who is looking for work and can find a job. And we want to make sure that inflation is staying under control and not getting out of control. We also want to avoid deflation too, which is a problem for other reasons. By the way, I should have said this at the outset, would encourage questions in the chat throughout the presentation. So if anybody has questions or wants to know more about something I've said, please offer a question up in the chat. I have a lot of slides, probably don't want to get through all of them, actually. It'll require me to stay a little succinct, and I'll try and leave some time for questions at the end, too. In any case, so that's sort of our 2 goals in mind, full employment and price stability, and we are not doing well on that price stability mandate right now. That's what we're seeing. That's the sort of I don't want to call it out of control, but accelerating inflation that we're seeing right now. It's actually, there are some signs that it's starting to temper a little bit, and I'll talk about that in a moment. But that's really kind of the context that I want you to keep in mind for everything else I'm going to be talking about, because I'll be talking about those 2 things. So if we could just go ahead and cut ahead 2 slides here. So I'm going to be talking about inflation first, because that's what's sort of on everyone's mind. And with apologies to those in the audience who aren't fond of statistics, I'm going to be talking a little bit really about how we measure inflation, not just because I think it's interesting as an economist, but also because it's important for understanding the causes of the high inflation that we're seeing right now and ultimately what the Fed can do about it. But kind of, I want to start on the next slide. I'm going to give you a kind of a broader historical context for the higher inflation that we're seeing right now. If you could go ahead and advance. Why don't you go ahead and advance actually 3 slides? Yeah, this is great. Yeah, so this is long-term inflation going back to 1800. What I'm showing you here is what's called the Consumer Price Index. I'll talk a little bit more about what that is and why it's a good measure of inflation and how it works in a moment. But I want you to just kind of think of this for the time being as being kind of the average cost of living. Or more relevantly, if you think about that sort of Aqua series here, at the bottom of the chart that then climbs up toward the end. Think of this as basically being the inverse of the value of a dollar. And that'll give you kind of a real appreciation for what inflation really is. Because we tend to think of inflation as prices going up, but actually what inflation really is the value of money falling. So money is really a commodity or good. Like other goods, it can be traded for other goods. What makes it special is it can be traded universally for all other goods, and we use it to measure the value of other things, right? We say it's the unit of account, right? So we're typically used to thinking of the value of things in terms of their price in money. If you want to understand the value of money, you need to think of what you can buy with it. And so when we have inflation, what's really happening is the value of the dollar is going down. We experience that as increasing prices, but ultimately that's what inflation is a decrease in the purchasing power of the dollar. So if you look at this chart of inflation going back to 1800, so that bluish colored line is the consumer price index. Again, that's kind of an average of prices of the cost of living. One thing you'll notice is that from 1800 to the early 20th century, there's not much change in that, at least not if you look at its value at one end versus the other. More recently, over the last 100 years or so, we've seen a steady increase in the price level. What happened during the interim? Well, in 1933, we went off of the gold standard domestically. The gold standard, and we weren't always on the gold standard, by the way, but I'm going to skip over some of American economic history because it's not the main purpose of my talk. The value of a gold standard is when you tie the amount of money in circulation to the amount of gold that can back it. It keeps the value of money stable over a long period. The problem with the gold standard is you tie the amount of money to the amount of gold that can back it. So it's sort of a double-edged sword, and you can see that reflected in this chart in the annual changes in the CPI over the same period. And what you can see is that during the period where we were on a commodity system where money was backed by precious metals, the value of the currency, while it doesn't change over the long term that much, it changes a lot from year to year. And that can make it a lot harder, at least in a sort of an industrial economy, for businesses to plan ahead. If you're thinking about if you're a manufacturer and you're purchasing inventories, and you need to think about whether or not the money that you're spending today to hold inventories is going to be worth more or less in the future, and that's going to affect your decisions. So what sort of all of the advanced economies around the world have kind of collectively decided over the last 100 years or so is that monetary systems seem to work better when we have a fiat monetary system that's managed by a central bank that has some public accountability. And that's what the Federal Reserve is, and that's what we have in other countries as well. And you can see that over the more modern period, we have kind of consistent and usually steady inflation. You see, the last time we really saw a big upsurge in inflation was in the 1970s. There are maybe some people in the room or online who remember that period well. That's the last time we saw inflation rates as high as we are now. And I'm going to move ahead to the next slide and talk about what's going on now. But that's a little bit of historical context I want to leave you with, so you can kind of just get kind of the bigger picture of what inflation really is. So I talked to you about the consumer price index. That's one of our measures of inflation. So like I said, ultimately inflation is about the value of our money. We can't really directly observe the value of money. We only know what we can buy with it. And so when we have inflation, it's not just that the price of certain goods is going up, it's that the price of everything is going up because the value of our money is changing. And so, well, the way that we measure this is by measuring prices. And really you can think of this price index as essentially being an average. Now what I'm showing you here is the annual rate of change, the 12-month percent change. And I've got it going back about 10 years. So on the last slide, I showed you what the actual value of the index was. This chart is really showing you more the rate of inflation. Now, like I said, you can think of this as being an average, but there are hundreds and hundreds of goods and services that are underlying this average. In fact, the Wall Street Journal just recently had a fascinating story about the economists at the Bureau of Labor Statistics, who collects and publishes the Consumer Price Index. The economists that they send out in into the field to actually gather this data. And they literally go to grocery stores, restaurants, salons, and other businesses, and they used to use clipboards, now they use tablets, and record the prices of goods. And they do this all around the country in 77 different urban areas. In any given month, they're recording about 150,000 different prices around the country. And they're not just recording the prices for goods, but they're recording also the prices for services. So they'll go to hair salons and ask, they'll ask, what a haircut costs, what a blowout costs. I don't actually know what a blowout is, but that's one of the things they reference in the index. In America, we spend a lot of our money on services, actually, and this is going to be important later. Now, of course, if you think about the way that you spend your money and the way your family spends your money, some things are a much bigger part of your budget than other things, right? And of course, those are going to be things like your cost of housing, your cost of travel, what you spend on gasoline. So those things get a higher weight in the index. And the way the weights are determined is the BLS again does a bunch of surveys, and they ask households about how they spend their money, and they use that to kind of determine how much weight to give each particular good or category in the index, right? The reason I'm explaining this is because I really want to give you a good appreciation for why we're seeing the higher inflation we are right now, and how that picture has changed over the last year. So I'm showing you two different rates right here. You could probably ignore the one that's in gold right now. So we usually use this term headline and core. Headline is the one that's important. That's the index for all prices, including food and energy. Sometimes it's instructive to strip out food and energy prices, not because they're not important, they're a really large part of people's budgets, but because they're a little bit more volatile. There's a bit more noise in them. And energy prices actually tend to come down more than a lot of other prices. So sometimes they're negative contributors to inflation, and you can see that reflected in this chart. So you get kind of a clearer signal sometimes of where inflation is heading. But right now, it doesn't matter which one you look at. Inflation is way too high. And we have the most recent month of data that we have is for April. The annual rate of inflation ticked down to 8.2%, which is still a lot higher than we want it to be. In fact, it's way higher than the Fed's target, which I'm going to show you on the next slide. This is a slightly different measure of inflation. I'm not going to sort of belabor the statistical detail here, but this is the Fed's preferred measure of inflation. It's called the Personal Consumption Expenditures Price Index. This is what they use to inflation adjust some of the macroeconomic statistics on consumer spending that come out on a monthly basis. There are a few advantages to this, so it doesn't just come from urban areas, it includes rural areas as well. The consumer price index mostly comes from surveys of households and consumers. This comes from also surveys of businesses, so not just what people are paying, but what businesses are charging. And then the really important difference is it takes into account some of the subtleties of consumer behavior. So the fact that when your price of rent goes up, you can't just stop paying rent. So you have to cut back maybe on spending on other things. That's also true for gasoline as well. You can't necessarily just buy less gas, especially if you have a long commute. So you might have to cut back on other things. In other cases, if you think about the price of butter going up, maybe you buy less butter, but you buy more margarine. So these substitution effects. And the way they calculate this index tries to take account some of those more sophisticated behavioral responses to changes in prices. Again, the reason this is important is because when we talk about inflation, we're not just talking about one price going up. We're not just talking about higher gas prices. We're talking about all prices, right? So if you really want to understand the cost of living, you need to think about the way people adjust their behavior. And that's what this measure tries to take into account. It does usually over time come in a little bit lower, but it mirrors the consumer price index pretty well. And again, it's sort of an academic difference at this point because as you can see, the most recent data we have are for March. We don't have April data yet, but it's still way higher than our target, which is 2%. I mentioned here the Fed's, at the beginning, the Fed's price stability mandate. For the last 10 years or so, the Federal Open Market Committee, which is the Fed's monetary policy making body, has officially declared 2% medium-term rate of inflation is our target, right? And you can see, since we declared that target, in late 2011, we've persistently actually run below that for most of the last 10 years until very recently. Running below that, we view it as a problem as well. And that's because in making economic policy, your reputation, your credibility is really important. So if you say you're going to do something, you better do it. And there was a period when we started to see some acceleration in inflation where the FOMC, again, that's the Federal Open Market Committee, which is the monetary policy making body of the Fed, was trying to make it clear that this isn't a ceiling, the 2% rate. It's a target, and it's symmetrical, right? We can undershoot it, we can overshoot it, but we want to be averaging that over time. So because we were running below it for so long, there was a period where we might have been willing to tolerate slightly higher rate of inflation than 2%, but now, of course, it's way higher than that. And importantly, what's changed recently is the rate of inflation has actually accelerated. It's not just that it's gone up above that target, but it's increasing. And it is the rate that we really focused on, the rate of change in prices, rather than the overall volume of prices. So once that rate of inflation comes, we're not trying to push prices down necessarily. We're trying to cut down inflation. I'm going to talk a little bit more about what the Fed's doing in response, but I do want to tell you a little bit more about kind of what's going on, why we're getting these higher inflation readings, and why the narrative has changed a little bit over the last year. The Fed has gotten a little bit of flack for using this term transitory last year, but I'm going to tell you a little bit about what the data were saying a year ago, and why it was actually reasonable to say at that time that this might be a temporary phenomenon. And I'll get into that in a moment. But first, I want to show you kind of just in a little bit more detail. Again, most people don't think, in the next slide, most people don't think in terms of what the price index is, right? That's only economists who care about that. Most people care about what actual things that they buy cost, and so you can kind of get a sense for where we're seeing the biggest price increases. So this is just April, the most recent data that we have compared to a year earlier. What are the things that increased the most? You can see, of course, gasoline, and this is post Ukraine invasion here, and we know what the effect of that was on the oil market. But overall, energy prices up quite a bit as well over this period, and they were climbing, I should say, before the Russian invasion of Ukraine. That just kind of accelerated that. But the third thing that you see on this list, I'm actually going to talk a little bit more about, and that's used cars and trucks. Why are used cars prices going up so much? And why is that important? Well, this is a bit of a supply chain story. So if you've been following this story of disruption, the disruptions in the global supply chain that we've seen over the last couple of years, really since the beginning of the pandemic, one of the biggest stories there is the semiconductor shortage, the microchip shortage. In particular, very limited availability and long delivery times for the lower tech microchips that tend to be made overseas. So not necessarily the high tech chips that are going in your smartphones or in personal computers, but really the ones that go into industrial equipment and into vehicles. So because in large part of problems in the supply chain, and most especially the microchip shortage, it's taken a lot longer to get new vehicles to market. And actually, just kind of a fun anecdote, I'm from Detroit originally. I was back home visiting my family a few months ago, and I don't know if anyone is a sports fan in the audience, but I drove by the former Palace of Auburn Hills site. That's where the Detroit Pistons used to play, and it's not there anymore. It's just a big empty lot, and right now it's entirely filled with GM trucks. And they're all trucks that have been manufactured and are ready to go to the market, except they're waiting to get a microchip. And there are inventories of new vehicles like this all over the country because of this microchip shortage. So what does that mean for us? It means it takes longer to get a car. New cars have gotten more expensive, and because new cars have gotten more expensive, people have been buying used cars a lot more. So used car demand is way up. Again, anybody who's bought a car in the last year knows this. Apologies if you have. But used car prices have responded, and you can see they've increased quite a bit. Why is this important for the rate of inflation? Well, again, if you think about what I was telling you about how these numbers are calculated, you don't buy cars a lot typically, unless you're a hobbyist, but it's a large part of your budget. When you do buy a car, it's really expensive. Most people have a car payment. So vehicles are a pretty large part of a household budget. So this is one thing that's been a big part of the inflation that we're seeing. But it's not all of it, right? I just want you to keep that in mind. You can see some of the other things. Actually, the next categories down are another instructive story. So that's going to be hotel lodging and airline fares. That's a pandemic story, right? We all know that these things fell off of a cliff in the beginning of the pandemic when nobody was traveling, and they're recovering now. And so as a consequence, airline fares, in fact, in April, it came down a little bit. The month prior, they were up over 20%, they were at 23%. Now they're up a little bit less than 20% year over year, and hotels as well. So this is all to kind of lay out a story that I'm going to tell you a little bit about the impact that we're still seeing because of the pandemic and because of these supply chain challenges that we've got. I'm going to move ahead to the next thing though, because I'm going to talk a little bit more about the supply chain issue on the next slide. And again, this in and of itself, you can think of them as being two discrete things: the pandemic, supply chain crisis. They're actually related, and this slide I think helps explain why. So go back to early 2020. And by the way, I want to point out, this is personal consumption expenditures. So this is one of the first things I'm showing you that's not price data. So I've got this and just broken down by different categories. These are indexed to their value in early 2020, in February 2020, right at the beginning of the pandemic. So this is consumption expenditures, just in total aggregate terms, on both services and goods. And I've got goods broken out between durable goods and non-durable goods. For those unfamiliar with the distinction, durable goods are big ticket things that last longer than a year, things like vehicles and things like appliances. Non-durable goods are things like household pantry items, processed food, things that last less than a year. And what you can see, like every other macroeconomic data series from the last couple of years, this plummeted early on in the pandemic. Actually, there's an exception to that trend, which is unemployment claims surged in the beginning of the pandemic, but that's not a good thing, obviously. So employment, output, most of the macroeconomic data that we look at really fell sharply early in 2020, and actually recovered pretty quickly. Now, it's interesting. If I were to go back longer in this chart, just to show you historical consumption spending going back 50 years, this tends to not move around a lot. It grows pretty slowly over time. Consumption is actually a lot smoother and less volatile than a lot of other macroeconomic data because people tend to balance out their spending with savings and with credit. So this just tends to see, we tend to see slow growth over time. Obviously, it fell a lot early on in the pandemic. Non-durable spending actually bumped up a little bit. That was a buying period when we were going into lockdown, toilet paper shortages. We all remember that. You can see that in the data. But that fell as well. But spending on goods, and especially durable goods, expensive, big ticket items, recovered really quickly and is up much, much higher than it was prior to the pandemic. And as I just said, typically we don't see consumption grow this rapidly in such a short period. It's up still now 30% higher than it was, almost 40% higher than it was prior to the pandemic. So ultimately, a lot of what we're seeing in the supply chain is about a traffic jam. You hear a lot of stories about backups at ports, a shortage of truckers, and a lot of other stories. Ultimately, what's going on is, as I mentioned earlier, Americans tend to spend a lot of our money on services. A lot of the ways in which we normally spend our money weren't available to us early in the pandemic when we went into lockdown. Weren't going out to restaurants, weren't traveling, weren't going to the salon. So people started spending their money on stuff instead of on services, and in particular on remodeling their kitchens. Sitting around at your house all day, working from home, thinking my deck looks kind of bad. Maybe I'm going to build a new deck. That was one of the first things we saw pop, actually, was lumber and construction materials prices. And maybe I'm not telling you anything that you don't know already because you've experienced this yourselves. But this has become true more broadly. People over the last couple of years started buying a lot more goods because they weren't able to spend as much money on services. And we saw that, in the next slide, reflected in, go ahead to the next slide, reflected in a big increase in the price of goods relative to services. So now I'm showing you the ratio of these two price indexes for durable goods to services. Again, if I were to show you this going back 50 years, then the overwhelming pattern is a long-term decline. Goods get cheaper relative to services, and that's a technology story. It becomes cheaper to produce goods. Services require a lot more labor to produce, and people don't get cheaper over time. And so typically the price of services goes up relative to the price of goods. What we've seen over the last 2 years, partly because of this substitution effect and change in household spending patterns, is that we've seen big increases in the price of goods relative to services. And so about a year ago, when we started to see inflation take off, there were some reason to think that some of the things that were pushing up on inflation were maybe temporary, or to use the verboten word, transitory at that time. And I'm going to give you a little bit of a blow-by-blow account and show you why that's no longer the case. And this kind of is a little bit of background for why the Fed is doing what it's doing. I'm going to just have you advance like 3 slides right now. One more, and then another one. Okay. So rather than walk you through these one by one, I'll just kind of give you if you look into early 2021, that was when we started to see the overall rate of inflation take off. I'm showing you now here the rate of inflation. That's that core rate stripping out food and energy. I'll show you. I'll bring food and energy back into it in a second, but I just kind of want to give you this picture. And now I'm showing you the monthly change. So everything I've been showing you so far has been year over year, but this is just what's happening to the inflation on a monthly basis, so comparing the month before. And what you can see is when we started to see the overall rate of inflation pick up in mid-2021, a lot of the movement that we were seeing was due to these big increases in vehicle-related costs for the reasons I just laid out, and also this recovery in pandemic-affected services. So just to give you a little bit more detail on what you're seeing in this chart, that darker blue part of these columns is the net effect on inflation of what I'm calling pandemic-affected services. That's a bunch of different spending categories on things like travel, on things like lodging, and on things like food away from home or eating in restaurants, things that were heavily affected by the pandemic. And you can see that early in 2020, at the outset of the pandemic, those were contributing negatively to inflation because people were buying a lot less of those things, their prices were falling. And there was a rebound effect about a year later once vaccinations started to spread, once the economy kind of started opening back up. And then at the same time, you were seeing this supply chain story with the vehicles. Everything else is in that light blue bar that I'm just calling other. And so going back to the middle of last year, we saw some higher inflation readings that were largely due to these sort of pandemic and supply chain stories. And actually over the following few months, that kind of cooled off. And so that story was looking pretty good at that time, especially not for reasons that anyone was happy about, but once we got into that kind of delta wave of the pandemic and activity started to come back down as cases were going back up, we started to see some negative pressure from those pandemic affected services. But then you go into the following few months, and not only do those things come back, but also you can see inflation is now spreading more broadly. So it's not really the case. It becomes clear once we get into late 2021 that it's not necessarily the case that this is due to just pressure in some parts of the economy due to the supply chain pandemic, but this is spreading more broadly. And we know this also from a lot of the survey work that we do of businesses, and we were hearing about their increasing input costs. And I'll just kind of give you a sort of a brief qualitative idea of, well, how the story we've been hearing from businesses has changed over the last 2 years. That initially back into late 2020 and early 2021, we were hearing from manufacturers and other businesses about how their input costs were soaring due to these supply chain problems, and they were eating a lot of those costs. It was just making it harder for them to do business and eating into their profit margins. But then they started to tell us that, well, demand is really strong, so we actually increased our prices, and it didn't affect our sales at all. And so we started to see those feed through from wholesale to the retail, to the consumer level, and that was a part of the story as well that I'm kind of skipping over here. On the next slide, I'm going to show you, as I mentioned a second ago, putting food and energy back into this picture. So this is once again the same the same information I was just showing you. What is the monthly contribution from these different categories to the overall rate of inflation? And again, you can see a lot of the action is still coming from goods prices, which is, I'm going back a little bit further in time here, historically unusual for reasons I've already mentioned. Goods prices don't tend to go up a lot over time. In fact, a lot of months they actually come down a little bit. You can see them on the negative side of these columns. But over the last year, we've seen much higher goods inflation. A lot of the inflation we're seeing is coming from goods, and then also food and energy at an increasing level over the last year is contributing to the overall rate of inflation. But again, if you look at services as well, that's increased. So now it's kind of more the case that which is kind of gets into what I'm going to talk about in a moment about what the Fed is doing about this. But one thing that I need to lay out first before I get into the Fed's response is the other side of our mandate. Next slide, please. And that's the employment story. Because like I said, we have these two goals that we're keeping in mind. We want inflation to stay under control, but we also want to make sure the labor market is really strong. Now, most businesses are telling us now that it's really hard to hire. We know that's true. We know it's true in part because we're seeing higher wage growth. But let me just show you how that picture looks. So I'm going to have you skip ahead 2 slides. So one way of measuring the kind of the stance of the labor market is to look at the unemployment rate. I'm going to argue that right now that's actually not the most informative metric for the labor market. The unemployment rate comes from the Bureau of Labor Statistics. They gather it via a survey of households. They actually call households up at random and they ask people, are you working? If you tell them yes, you're working, of course you're counted as employed. If you tell them no, I'm not working, then they ask you if you've been looking for work. And if you say no, I'm not working, but I'm looking for a job, I'm in the job market, then you're counted as unemployed. So importantly, the unemployment rate doesn't count people who quit looking for work for a variety of reasons. It doesn't count people who are retired. It doesn't count people who decided to leave the labor force and stay home and care for children, full-time students, variety of other things. If you just look at the headline rate of unemployment, and I'm not showing, I want to apologize for not showing Wisconsin on here. I should probably be including Wisconsin because I know we have some Wisconsinites in our office, or in our audience rather, and probably in the office as well. The Wisconsin rate of employment looks pretty similar. It's actually between the US and the Minnesota rate of employment, a little bit higher than Minnesota. In Minnesota, the unemployment rate is down now below where it was at the beginning of the pandemic. We're down at 2.2%. These data just came out last week. National rate of unemployment is still a little bit higher, but really low by historical terms. We're just above 4% nationwide. Wisconsin's at 2.8 right now. And so that's, so if you just look at the unemployment rate, in fact, even going back to the beginning of last year, the unemployment rate, especially in our region, where we tend to have lower unemployment rate historically than the US rate, was looking pretty good. But as I just mentioned, I don't think that's giving us the whole story, and you see why on the next slide. So this is a different measure. This is non-farm employment. So you're just think of this as total pay, what we call payroll employment sometimes. This also comes from the Bureau of Labor Statistics, but this is from a survey of businesses. They ask businesses how many people are on their payrolls. So this is just basically, this is the total number of people working nationwide. And you can see we're not back to where we were at the beginning of the pandemic. It fell off of a cliff in April of 2020, a little bit in March as well. So at the worst stage of the pandemic recession, we were down 22 million. And actually, by historical standards, we recovered really quickly. And part of that is just due to the unusual, weird nature of the pandemic and the shock that hit the economy being kind of a self-imposed shock from going into shutdown mode. So employment recovered pretty quickly. But getting into the middle of last year, when we were seeing inflation take off, we were still close to 10 million below peak pre-pandemic employment. Now, one of the challenges with this dual mandate that I've been laying out is that while we can easily say our price stability target is a 2% rate of inflation and call that good, we're really good at measuring inflation, we don't really know what maximum employment looks like. There's not a magic rate of unemployment. There's not a magic employment to population ratio or any other metric where we can look at that and say, this is full employment. So what I can tell you right now is that we're still more than 1 million people below the pre-pandemic peak. I want to point out, actually, this doesn't include the latest month of data. We're still 1.2 million below pre-pandemic peak as of April. So 1.2 million people fully nationwide, fewer people working. Now, again, does that mean the labor market is really bad? Most businesses would tell you the labor market's really tight. A lot of we have a number of indicators that point to a really strong labor market. You've seen really fast wage growth. We also know from looking at the data on quits, the number of people who are voluntarily separating from their jobs, that's at an extremely high level right now. So it's very much a worker's market on the job market. Now, going back a year ago, we sort of perennially hear from businesses in our region about how tight the market is, and that was true a year ago. It was true 10 years ago, frankly. That's kind of a long-term structural feature, and that's a topic for a whole other talk that my colleague Ron Wirtz might get into next month. That's something I was talking about a lot prior to the pandemic. But nationwide, and the Fed's policy is focused nationally. We know that that we're still below the pre-pandemic peak in employment, but we have some other indicators that tell us that we're pretty close to full employment because of the growth that we're seeing in wages, because of these things like the quick data, and the question is, how are we going to get back to that previous peak, or rather, how long is it going to take us to get back to that previous peak? I don't want to leave you with the impression that we view that as somehow, like in February 2020, we were in an ideal world where the job market was really great. But just looking at the aggregate numbers, we know that we're below where we were. There are lots of reasons to think that we're not going to get back there for quite some time. Because again, for reasons like I mentioned, we know a lot fewer people are. We know that a lot more people have pulled out of the job market, in particular women, to care for small children. If you look at just the employment rate among prime working age males, that's males 25 to 54, that's really high right now. Again, another indication that we're probably closer to a full employment. If you want to skip to the next slide, I'm going to show you just a slightly different measure of stance to the labor market. This is just taking into account, so just looking at the overall aggregate level of employment doesn't necessarily tell you where we are relative to the size of the population. So this is the employment to population ratio, basically how many people out of the eligible working age population are employed. We're still below where we were pre-pandemic. This one actually also, we've got another month of data that's not reflected on this chart. That just moved sideways over the last month. In fact, it went up slightly to 1.2%. Again, don't want to leave you with the impression that we have February 2020 as a goal. This is just to say that over the last year, as we started to see accelerating inflation, there were reasons to think that there was still a lot more room for recovery in the labor market. And in fact, last month, nationwide employment grew by another 500,000 people. So we know that there are still a lot of people sitting on the sidelines that are coming back into the labor force, in part because the job market is so strong, wages are growing so fast. What role inflation is playing in that is another question. Are people coming in because their cost of living is going up? They need to entertain going back to work when they were able to have maybe just one income earner in the household before. So that's all just to kind of lay out for you where we are relative to that dual mandate. Inflation is way higher than we want it to be. It's accelerated. It's spread more broadly throughout the economy to a more broad class of goods and services, kind of the price of everything going up. And the job market has recovered pretty well from that big shock at the pandemic, which is to kind of explain why that has changed stance. So we're going to go ahead and skip to the next couple slides here. So that's kind of where I'm gonna spend the rest of my time here. I know I have about a little less than 20 minutes left. I should pause and see if we've had any questions in the chat before I go any further. And nothing's come in? Okay, great. All right, so with the rest of my time, I'm gonna kind of lay out what the Fed's response to this has been. And I'm gonna have you skip ahead through the next, why don't you go through 2 slides here? Keep going, yeah. Okay, so you can see the Fed, our primary tool for monetary policy is the federal funds rate. That's I don't need to explain to anyone in the room here what that is. That's the overnight lending rate between banks. There's a market for bank reserves. Some banks end the day with excess reserves. Some banks end the day a little bit shy of their reserve target. So this lending market exists between banks overnight. Most of us, if you're not a banker, don't really think about this. This isn't an interest rate that really influences most people's behavior or decisions. But this is a market that the Fed can directly intervene in by influencing the supply of reserves, by buying and selling securities from primary dealers. And that's what the Fed actually does when it changes monetary policy. So let me back up and actually just explain how that process works. I described how the Fed is structured earlier. We have these 12 reserve banks around the country. There's a board of governors in Washington that oversees the operations of the Fed. That's actually a government agency. Jay Powell is currently sometimes referred to as the chair of the Fed. Who that actually is the chair of the Board of Governors. Prior to him, of course, it was Janet Yellen. Before that, Ben Bernanke. They get together 8 times a year, the 12 presidents and the members of the Board of Governors, and they talk about the state of the economy. Each of those Reserve Bank presidents gives an update on economic conditions in their region. And they sort of argue about what the right stance of policy should be. And one of the things they determine is what the target should be for this Fed funds rate. And then after they set that target, the trading desk, the markets desk in New York, has to actually execute the transactions to make this happen. So they set a target. They don't just pull a lever and change interest rates overnight. They actually have to intervene in this market. So kind of belaboring the point here a little bit, just to kind of explain how this works. This is one of our really key levers. It's an extremely short-term rate of interest. I mean, it's literally an overnight rate of lending between banks, but it influences other rates of interest. So what you can see, if you look at this chart over the last few years, that shaded area there is the recession that was induced by the pandemic, and you can see the Fed lowered interest rates very rapidly down to 0. In fact, actually, early on in the pandemic, in February of 2020, they had an unscheduled meeting where they cut by 50 basis points by 0.5%, and then at the next actual scheduled FOMC, the next scheduled FOMC meeting, they went all the way down to 0. And we've been there more or less ever since, until March, where we raised the rate 25 basis points. And then at the last meeting a few weeks ago, we raised the rate another 50 basis points. So 0.75 increase in the rate of interest. Whoop-de-doo. That in and of itself doesn't seem like a lot of movement, but as I mentioned already, most people don't really change their behavior based on this particular rate of interest, and the reason we target this is because it influences other rates of interest. And if you move ahead to the next slide, you can see the real key channel through which these policy actions work is not this particular rate of interest, but their influence on other rates of interest and on expectations in the market. So there's a futures market where investors are essentially betting on the future federal funds rate, and you can see that reflected here in this dotted line, and they're pricing in, this market is pricing in further rate increases over the course of the year. So the Fed, as I mentioned, kind of reputation and commitment and how that's an important part of how we do business. One of the things that the FOMC does after it meets is it releases a statement, and that's the official record of the stance of monetary policy, and they try and be very clear about their intentions. And what they've been signaling recently, what they were signaling actually before the March meeting when they actually moved rates, was that we were seeing these accelerating signs of inflation and we were going to have to tighten policy in response. So they don't necessarily come out and commit to, we're going to raise rates X number of times by Y% over the coming year. They try and make it clear that these decisions are being guided by the macroeconomic environment, and the macroeconomic environment is such that there's going to be continued need for tightening. And that affects other interest rates, as you can see on the next slide, where I'm showing you treasury rates. So these are the rates on constant maturity rates on 2-year and 5-year US treasuries. So again, one of the kind of sort of broader market interest rate indicators. And one thing you can see if you look at this is that these rates actually started climbing before that March meeting, because markets were anticipating that the Fed was going to change its stance, was going to raise rates, and they were pricing that in. And then right after that March meeting, they shot up even higher. And you can see that the movement that we've had actually in these market indicators of interest rates are quite a bit more than what we've actually seen happen in the federal funds market. Again, because the channel through which we're acting is through expectations and through longer term interest rates than just the one key rate that we target. And you can also see, and most relevantly to people in the room is going to be the next slide, where I'm showing you 30-year fixed rates. Those have come up a lot. Again, started to climb early in the year before the Fed actually moved, because markets were anticipating that move, and then jumped quite a bit after the March and then the most recent May meetings. And we're up about 5% now for the first time since I think 2018 was the last time mortgage rates were this high. So what does this all mean? Well, monetary policy, the channel through which it operates is demand. So by tightening monetary policy, we're raising interest rates, and that's going to make it more expensive to borrow from a bank to do, for example, a home renovation loan, to purchase a car. It's going to make it more expensive for businesses to finance expansions and plant and equipment. And so it's really through the demand side of the economy that monetary policy operates. One of the challenges that we have is, as I've been laying out for you, a lot of the inflation that we're seeing is actually more kind of on the supply side. We can't necessarily do anything about that supply chain crisis. To the extent that it's being driven by really strong demand for goods, though, it might have some, there might be some response. So our challenge is to try and keep that dual mandate in mind. We want to bring down the rate of inflation, but we don't want to do it at the expense of tanking the labor market, of driving us into a recession, and of driving unemployment way too high. That's a challenging course to steer, and the monetary policy is very much an art as it is a science, and so that's sort of the course that we're trying to maintain right now. I am actually pretty optimistic about this, and again, speaking for myself, by the way, and not necessarily the Fed, but just to kind of give sort of an optimistic picture. One big difference between now and the last time we saw inflation this high, back in the late 70s, early 80s, is that the job market's really strong. So the big challenge in the 1970s was what they called stagflation, the fact that we had persistently high inflation and also high rates of unemployment. Right now, we're very clearly on one side of that trade-off, and there's a whole sort of history of economic thought that goes into that I probably don't want to get into right now about this sort of the Phillips curve and whether or not policymakers can exploit this trade-off between unemployment and inflation. We don't really have to worry about that right now, though, because even if demand cools off and we start to bring down the rate of inflation, the job market's still really strong. And in fact, lower rate of inflation is going to be good for workers because it's going to bring their cost of living back under control, and it's going to mean those increases in wages that they've been experiencing because of the strong job market are actually translating into a higher real increase in their earning power. I'm just going to kind of wrap up by talking about one of the other big channel or tool that the Fed has in terms of monetary policy, and that's on the next slide here. And that's the balance sheet. So I mentioned kind of the federal funds rate and the normal tool that the Fed uses to enact monetary policy. We're through that short-term lending rate. Well, that's an extremely short-term rate, as I laid out earlier. We pushed that down to zero very early in the pandemic, just as we did early in the financial crisis of 2007 to 2009. Once you get down to zero, there's not much further you can go. And so one tool the Fed has to try and push down on longer term rates is large-scale asset purchases, what they call sometimes in the financial press quantitative easing. It's really more akin to printing money. So the Fed credits depository institutions' reserve accounts and buys, in this case, mostly mortgage-backed securities, agency mortgage-backed securities. So these are Fannie and Freddie securities. So implicitly U.S. government debt, because those are owned by the U.S. government, and then also U.S. treasuries. So you can see early on in the pandemic, big expansion in the balance sheet. That was because we went down to zero in that short-term rate. We were trying to move down longer-term rates, and that's continued. They've continued those purchases on a preset path every month, every time the FOMC has met 8 times a year. They've announced what they're going to continue doing in terms of asset purchases. And the big change they just announced, and they gave again a preview of this earlier at the last meeting. They announced that they're going to be that they've halted new purchases and that they're letting our existing portfolio start to mature and roll off our books. So they're doing that at a controlled rate. They're starting with $30 billion a month, moving up to a higher rate later in the year. But the idea is, you can see reflected in this chart, essentially a big injection of liquidity into the economy that's just basically consisted of purchasing a lot of assets. These assets will eventually mature, and rather than roll those over or roll all of them over, we're going to let them roll off And that'll also be another way of removing stimulus from the economy as we added it early on in the pandemic. Happy to answer more questions about that if anybody wants to know more about that. Just going to end with one kind of quick slide, just kind of showing you longer term inflation expectations on the next slide. And it's the kind of picture I want to leave you with is that while we're seeing higher rates of inflation right now over the last year, if you look at some of the market indicators we have of forward inflation rates over the next kind of 5 to 10 years, those are still pretty well anchored. So markets are guessing that we're going to get this right, that we're going to bring down the shorter term rates of inflation that we're seeing right now, and then over the long term we're going to be closer to that target. And I have kind of two indicators as a survey of professional forecasters, and then also this zero coupon inflation swap that kind of gives you the market's best guess of what the inflation rate is going to be 5 to 10 years out. So that's a little bit of good news. If you want to read more of that, I'm going to put in a quick plug on the next slide. If you want to read more about this, my boss, Neil Kashkari, the president of the Minneapolis Fed, has an essay up on our website, minneapolisfed.org, where he gets into a little bit more detail, in particular about the current state of play, whether or not policy has tightened enough, what the risks are, and the factors that are kind of influencing his thinking about this, some of which I've talked about here and some of which I haven't. And with that, I'm going to see if we have any questions in the room here or in the chat. If you could just put up that last slide, just so folks know how to reach me if they have any questions that we don't get to right now.
Okay, so there's no questions through the chat at the moment.
Okay. Very good. Well, I think, Chad, you said you had a couple words you wanted to leave folks with.
Yeah. Joe, we want to thank you for
Very happy to be here.
very informative and interesting talk.
Thank you very much.
Maybe I feel a little more upbeat.
I'm an optimist. I want people to feel better.
Well, we appreciate everyone joining today, and we look forward to seeing you join us on June 23rd as well. So continue to check the website. And thanks again.